So now in the last lesson, we saw how Mike went out and bought 10 shares from Ben. So he is now the owner of Johnny's Lemonade Stand. He paid $12,500 for his shares. How are those shares going to make money for him? So the first way Mike is going to make money on this investment is with the dividend. So the dividend was $1,250 per share. Mike paid $12,500 per share. So his total investment, if we add up, 10 shares times 12,500, he paid $125,000 for the stock. That means he's going to get $12,500 per year as a dividend. That's one way he's going to make money on this investment. The second way is if the price per share increases in the future. Now, what would cause the stock price to go up? Stock prices generally go up if the underlying fundamentals, or the earnings, profits, dividends of the company in which that stock represents, are also increasing. So this is the breakdown of the profits per year of Johnny's Lemonade Stand. We saw that in year number 1, the stand made $0. Year 2 made $50,000. Year 3, $100,000, etc., etc. When we got to year number 7, this is where Mike bought his shares. So the company at that time generated $500,000 in profits for 200 shares, which was a $2,500 earnings per share. Johnny decided to pay half of that to investors as a dividend. The other half he reinvested back into the business. So the dividend per share that year was $1,250. So this is where Mike's 10 shares that he just bought are going to pay him. This times 10 equals $12,500. In year number 8, the company makes $625. In year 9, makes $750. In year number 10, let's say Johnny's Stand is generating $900,000 in profits. If there are still 200 shares outstanding, that means the earnings per share have increased from $2,500 all the way up to $4,500. If Johnny still pays half as a dividend, that means the dividend has gone up $1,000 per share. So now his shares, his 10 shares, are going to pay him $22,500 per share versus the $12,500 they were paying. He also collects the entire time he's collecting dividends. So he's collecting all of this is being paid in cash. But now the question is, let's say he wants to sell the stock in year number 10. So what is he going to get for those shares? Well, now that those are paying $2,250 per share as a dividend, let's say another investor, say Tom, comes along and he wants to make 10% return on his investment, just like Mike did when he bought. So he's going to take $2,250 per share divided by his required rate of return of 10%, and he's going to be willing to pay $22,500 per share. So Mike, on his investment, is going to make dividend payments for those 3 years, and he's going to sell his investment, his 10 shares. He bought them for $125,000 for 10. He's going to sell them for $225,000 for those 10 shares after 3 years. So he made money from dividends was the first way, and he also made money from price appreciation. And those are the two ways that stocks make money for you.